This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, 𝗦𝗘𝗕𝗓𝗓 and 𝗕𝗏𝗡𝗖𝗓.
Eric, it was great to have Marco on the show. Now, joining us again in the Postgame segment is 𝗦𝗘𝗕𝗓𝗓. Now, let's get to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Marco's picture that says Looking for the Downloads. Now, Eric, let's get to crude oil, starting with the EIA inventory.
EIA printed a drawdown on crude oil of 4.6 million barrels. Cushing, Oklahoma, building 1.8 million barrels. The big builds were on the finished products. Gasoline building 5.4 million barrels. Distillates building 1.2 million barrels. U.S. production ticking down to 13.1 million barrels. Despite the big drawdown, crude oil was down hard this week, with WTI closing on a 69 handle on Wednesday. The big product builds contributed, but the real reason is deeper than that and requires a little bit of explanation. Initial signaling from the delegates at last week's OPEC Plus meeting was for an OPEC Plus cut, which didn't actually happen. As I explained in last week's commentary, generally speaking, they go into these meetings with consensus formed ahead of time, expecting just to codify a decision at the meeting. But sometimes that consensus breaks down at the meeting, and that's what appears to have happened here. Now, this all came about after a squabble occurred inside of OPEC Plus about an adjustment to the baseline production levels for Angola and Nigeria. The way this works is that OPEC Plus cuts call on all of their members to cut production below whatever their established baseline is. But when a country like Angola or Nigeria is unable to meet their production baselines, in other words, for the sake of round numbers, let's suppose that they have a baseline of 1 million barrels, but they're only able to produce 900,000 barrels because that's as much capacity as they have. What happens is if OPEC Plus says, well, let's cut production by 10%, and that creates a financial burden on all the other members, well, somebody who's only producing 900,000 barrels and has a baseline of 1 million barrels is really not going to feel any effect from that, because cutting from 1 million to 900,000 is just cutting down to what they're able to produce. They don't have to actually cut anything. So there was a move to adjust Angola and Nigeria's baselines lower. They were resisting that, and that appears to have been what the basis of this contention inside of OPEC was about. Reading between the lines, my guess, and I don't know this for certain, is that after losing that unanimous consensus that was required for a formal decision from OPEC Plus to cut production, the remaining members tried to save the day by having everyone but Angola announce a voluntary cut equivalent to what the OPEC Plus that didn't happen would have been. In other words, they were trying to tell the market, look, we're doing essentially the same thing as an OPEC Plus cut, it's just Angola didn't participate. The market didn't buy it. The way the market is interpreting this is OPEC Plus is losing solidarity and therefore losing control over the market. Skepticism now abounds that OPEC Plus will be unable to establish consensus for future production cuts, which again require a unanimous vote of all of the delegates at the meeting. The assumption that OPEC would defend $80 Brent was what was holding the market up in the first place. Now the perception is OPEC Plus may not be able to defend $80 Brent, and all things considered, the only thing that I'm absolutely certain of is I'm pretty darn sure that nobody at OPEC Plus is terribly happy with Angola at the moment. But I won't be surprised if OPEC Plus gets its act together and makes a new announcement shoring up solidarity, cutting production, and, Putin's visit to both the UAE and then Saudi Arabia is definitely significant here. If we see Russia and the Saudis and the Emiratis all come together together and build consensus in OPEC Plus. Those are the big producers. Those are the ones that count. And certainly solidarity among those producers ought to be enough to return confidence to the market. Meanwhile, I think the market is probably set to continue selling off until something happens to signal that solidarity is back. After testing $69 on Wednesday afternoon, we're back to just barely above 70 as I'm recording very early on Thursday morning. Let's see what happens here. But if there is no signal that OPEC Plus has shored up solidarity, I think there's plenty of room to go back and test the lows from early spring of this year when we got all the way down to the low 60s. I don't expect that to last. I think that OPEC Plus will get its act together, establish the solidarity that they need, and reassure the market. It's a question of how long it takes them to do that and what happens between now and then.
What an ugly chart, Eric. Like, price action was so weak. It's simple. I just have a 50-day moving average on here, and that price action couldn't get above 80. We talked about how important there was to be the bulls to be able to show some sort of accumulation, and instead it rejected right along the resistance level, never showed any follow-through, and now with this breakdown, we are testing the 2023 lows. I mean, we're still a few more dollars away, but it's a stone throw away. The weakness is approaching an oversold state into a support line. Typically, this is where at least a short-term swing low occurs, but it's going to be far more interesting in the weeks and months to come whether this is a line in the sand where the bulls can hold and defend the support lines or whether this downtrend continues. So coming to a very key support line where at least a bounce is very common. Now, Eric, before I get to Nick here, what's your thoughts on the S&P 500?
Well, I bought puts on S&P futures this week and will continue to accumulate more if we get a Santa Claus rally. 46.12 was my upside target that I described a few times here on MacroVoices. We came within just a few ticks of hitting it. If the rally fails here with no Santa Claus rally into year end, as so many people had expected, that could be the tell that much more weakness is coming in January. But let's see what happens as we get into the end of the year. Santa Claus rallies, certainly from a seasonality standpoint, happen very commonly, so let's not discount the possibility completely.
All right, Nick, I want to get you involved in this conversation. Let's just start off with the actual levels that the options markets are giving. What are you watching?
Yeah, Patrick. So spot price right now on SPX is approximately $45.50. We have an implied move for next Friday's December 15th OPEX at plus to minus 80 points, which denotes an upper potential move of 46.30 and a lower potential move of 44.70. Key resistance right now, also where the call wall resides, is at 4,600, and key support is at 4,500, also just above the put wall at 44.50. Now, I'm inclined to think that we see some steady action into FOMC, which is next Wednesday, and the CPI print, and thereafter, it's likely we see a big move in either direction. I'm inclined to think we see a rally perhaps to the 46.50 area, before seeing a pullback down toward the 44.50 area into the February OPEX. So I'm bullish into January OPEX, bearish thereafter. What are your thoughts?
Yeah, well, the S&P 500, first of all, it's important to note that we're about to do the contract roll, those that are tracking the S&P 500 futures contracts. When that contract roll occurs, the contango between the December-March contract is over 50 S&P points. So it's probably best to do analysis directly on the cash index where that gap is not going to be technically messing up the charts. With that said, that 4,600 is formidable resistance, but to me, it's all about this news. I mean, we're going to get the jobs numbers tomorrow, followed by key inflation numbers, and then the FOMC. It's like all of the major news was just loaded into one major week here, and likely almost all the market volatilities are going to occur here because with so little news coming in the latter half of December, it's very likely to transition into a low volume, low volatility lull period in there. And so what the next trend move here in the S&P is probably going to to be determined here within even 2-3 trading sessions. For me, we are very overbought. A pullback is in the cards, but the question of how deep the pullback goes is actually going to be the tell. If we have a very modest pullback of, let's say, another 50, 60 points, holding the 4,500 support lines, that becomes a springboard where a break to higher highs toward even 2021 highs is something that can't be ruled out. But if this news is in any way determined or interpreted slightly bearishly, then any breakdowns like 4,400 or deeper, then it's very likely the highs of the year are in. And so it's a fine line here. A pullback is in the cards, but how well it's defended is going to determine whether there's one more impulse higher going into early January. All right, next, let's though talk about that QQQs and the NASDAQ. What levels are you watching here?
Spot price right now on Qs is 385 approximately. We have a implied move for next Friday's December 15th OPEX of plus minus 9 points, which denotes an upper expected move of 394 and a lower expected move of 376. The call wall above is just above at 390, and the put wall is below at 380 right now. Key resistance is at 390 and key support is at 380. As I said in previous weeks, I do think that tech is overextended and perhaps overvalued as well. I'm in favor of the small caps, which have done very, very well the past few weeks. One name that I do actually like right now is Google. After seeing their demonstration yesterday on YouTube of their Gemini AI bot, it was very impressive. I thought it was much, much more advanced than ChatGPT, and therefore I'm bullish in the short term on Google, but the rest of the names I'm not so bullish on. I think that small caps will continue to outperform, especially if we resume a rally to the upside to 46.50 perhaps. I think 190 or so on IWM is in the cards. What are your thoughts?
Well, you know what? The Mag 7 have been the leadership, and they certainly paused here over the little bit, but I think it's premature to already be putting the nails in the coffin on like the momentum of them running out, while the small caps have certainly had a very strong reflexive snapback. I don't want to count out the Mag 7. These kind of trends tend to last longer and squeeze out shorts more often than not, and ultimately it does resolve itself in that way, which is when something overshoots that much, it'll correct. But I think that at this stage, especially if the market is well defended here, the Mag 7s may end up still at least holding up this year. Though let's talk volatility here for a second, Nick, because on page 6, we have the volatility index. And in spite of us having all of this huge economic news ahead of us going into next week, we're basically at year lows on volatility. We're back to slightly above the 13 handle, but it's still very, very low. The market is simply not anticipating any big swings here. What's your take on the volatility?
Seeing the VIX at a 13 handle right now indicates that we should see daily top to bottom moves of approximately 0.8% roughly. And with that in mind, what we've seen over the past few weeks is consolidation in a very, very narrow range on the S&P. So just for reference, a few weeks ago, I mentioned that the expected move for December 15th OPEX was 110. Then it was 100. Now it's 90. Simply because we've sat in this very narrow range between essentially, 45.30 and 45.97 or so. So a pretty narrow range for about 3 weeks now. And what happens there is that there's no cue for any large market participant to purchase out of the money calls or puts, which may drive some gamma to the upside or downside perhaps. And so we're seeing this kind of wait and see approach for the FOMC, which is next Wednesday. What I'm thinking is that we perhaps see consolidation in this range into next Wednesday, see a pop in the VIX after FOMC if Powell remains hawkish. And then next OPEX for January is where I would look for an expansion in volatility to occur. Just for reference right now, it is extremely cheap to buy insurance for next year. So for example, I was looking at a play, just again, as an example, selling February OPEX, 46.50, 4,700 bear call spreads for a credit of about $22 on 28 risk, and using that premium to purchase next June's 4,000, 3,500 bear put spreads for a net debit of about 28 points. So overall, the net debit's about $6. If you leg into it, you may be able to get about a roughly zero debit cost, 500 point wide put spread, which would act as insurance to your portfolio for the next roughly 6 or 7 months. But anyways, moving on to the US dollar on page 7, what are your thoughts here, guys?
The Dixie entered a new downward price channel back on November 1st, but broke out of that channel to the upside this week. Modest resistance starts at 104 and then significant resistance at 105 on the March contract chart. Only a close over 106.75 would signal a really big move higher is afoot. So I think it's a question of how far we're going to get. Is this just a correction? Let's see how it plays out.
Well, we got a bounce in the dollar from a very oversold state, but what is noteworthy to me is that it really came predominantly from the euro. We still have a US dollar yen that just broke down again today. A lot of the other cross currencies are not that far off from their consolidations lows. And so you have a scenario where the euro made its move and caused the dollar to react. But really, to me, it's going to be about whether or not the dollar starts moving against all of the cross currencies together. That's where the major US dollar trends occur. And that simply is not the case right now. So as we approach this 104, 105 level, if that pattern continues, I'm going to be looking for the US dollar still to struggle here. It's just a little bit of a bounce, but I think that the dollar trending higher is going to really need a very clear macro backdrop all evolving at the same time. And at least now it doesn't seem to be the case. Now, obviously, we have some major economic news coming out. So by the time we do the next episode, that news may have started the trend. I think one of the simplest things to do is simply watch the 105 level, because the dollar turning bullish would mean some sort of sustained price action breaking out that area.
Now on page 8, we have the gold futures chart. What are your thoughts here, guys?
Wow, talk about a whipsaw in the futures market on the Sunday open into thin liquidity. We hit our 2140 measured move target and then traded over 2150 on the February contract in that thin liquidity trading on Sunday evening and the melt-up, only to see a blow-off top and a full retracement by Monday morning. The technical analysis picture is very fuzzy now because steep contango makes the continuation chart and the contract chart so completely different. On the contract chart, we've already retested the Halloween highs that were previous resistance, and we've now tested them as support. But in the continuation chart, we need to move another $20 or so lower, or even $25 below the market as I'm recording early Thursday morning, in order to test 2020 on the February contract, to close the gap that was created by the contango in the contract roll and retest those late October highs as support. But again, that's on the continuation chart. We've already done that on the contract chart. My rule for this is when the contract chart and the continuation chart don't agree, there is no book to turn to say, what's the official answer in technical analysis? Which one are you supposed to go by? Opinions abound on this. Different people are going to interpret it different ways. That means technical analysis is going to be a little bit less reliable because different people are working from different interpretations of different charts. The next supports below that is channel support and the 21-day moving average, which are co-located down at 2003. Given that the slow stochastics are still pointed sharply down, I think a test of 2020 on the February contract is likely before this correction is over, and a test of 2,000-ish or just above 2,000 round number support and channel support is entirely possible, especially if the dollar rally continues. If that happens, though, I'll definitely add to my longs on the dip.
Eric, the technical levels you are watching were bang on because I had the same measured move on the upside of gold. That move did, on an intraday basis, break to an all-time new high. And on the monthly charts, we remain above the 2,000 level, which is the monthly close highs. And so we have a scenario where gold remains structurally bullish. Overall, it may end up spending much of December still just backfilling and consolidating, but this is a bullish chart. that is consolidating along its highs, and there is zero evidence that a new downtrend has begun. Just because it failed to hold a breakout is not enough evidence that somehow some major downtrend is going to get underway. And so I still have always been far more bullish in 2024, and maybe the rest of the last few weeks of the year end up just being gold still creating a base from which it will be bullish at a latter point in the future.
Eric, you wanted to discuss uranium. What's on your mind here?
At the 𝗕𝗏𝗘𝗖𝗜𝗔𝗟 climate conference in Dubai, 24 countries so far, that's 24 and counting, have signed a pledge to triple nuclear power capacity by 2050. Now, this was pure politics. No concrete plan of action for actually accomplishing that goal was even discussed. So obviously it doesn't affect supply and demand in the here and now. But I still see this development as potentially being incredibly important. And the reason is that it happened at the COP conference, which is basically the mecca of the climate change community. So my expectation is that this event will effectively greenlight investment in all things nuclear by the renewable energy, ESG, and climate communities. In other words, all the people who used to boycott investing in nuclear because they thought it was bad, because they thought it was against their green climate agenda, I think might be persuaded by this announcement, or this might be the catalyst to bring about a change of attitude where all of a sudden nuclear is in again, including with the ESG crowd. If there is a sudden new hot trend in nuclear investing among institutional investors, let me be clear. There simply is not enough capacity in the uranium mining sector to absorb institutional-sized capital flows without causing a massive upside price dislocation. This has the potential to be a setup for a huge rally in all things nuclear, especially in uranium mining stocks. But that's only if I'm right about the ESG crowd interpreting this symbolic gesture at COP28 by these 24 countries as a green light for investing in all things nuclear. If they can still consider uranium mining to be evil, well, then it's not going to make any difference. So let's see how they interpret the significance of this potential catalyst and whether it helps to accelerate the rally in uranium.
Yeah, that summit really just solidified the fact that uranium is coming back into vogue. And so your observation is correct. But one thing when looking at that chart, Eric, on page 9, is that the spot physical uranium trust and the U3O8 contracts have just been nonstop, go in a bull trend, making higher highs. It's a trend that continues and it's getting a lot of love. And it really doesn't seem to be letting up here. So it'll be really interesting to see whether this actually gives that traction that you're referring to, and whether or not this trend accelerates here. It wouldn't surprise me at some point for these rallies to get checked, but it is probably one of the most bullish themes out there, and it's been working very, very well all year long. Just quickly on one final note, we had a very positive response to our special webinar last week on the extraordinary opportunity to protect your portfolio from market volatility in 2024. But we had many inquiries on people that missed it. So we're hosting a follow-up webinar on Monday, December 11th at 1 p.m. You can register directly at bigpicturetrading.com.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts 𝗪𝗘𝗕𝗓𝗓 and 𝗪𝗕𝗓𝗔𝗔 shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.